Thank you for joining us today to discuss relief effort considerations for banks related to COVID-19. We're in an unprecedented time and new information is coming out at a fast pace, and we want to ensure you have the necessary information and resources to help during this time. Before we dive into the discussion, we need to get to the legal stuff out of the way and inform you the material appearing in this presentation is for information purposes only and should not be construed as advice of any kind, including without limitation, legal, accounting, or investment advice. With me today, we have some amazing people from around our firm to discuss various relief efforts that are available and other items banks should be considering. My name is Theresa Wright, and I'm an audit senior manager working in our financial institutions practice. With me today, we also have Gabe Nachand, audit partner, who's our financial institutions national practice leader. Kristine Hoeflin, tax partner, who works with a significant portion of our financial institutions across the firm, as well as Chad Flaherty, another senior manager who's heavily involved in our financial institutions practice group. And finally, Noory, senior manager in our financial services advisory and consulting group. Our contact information will be at the end of this presentation, so please don't hesitate to contact any one of us if you have additional questions. We have a full agenda today and we'll be covering various items, including some of the lending programs available to borrowers, accounting and tax consideration for loan modifications as it relates to COVID-19. We'll also discuss the Families First Coronavirus Response Act and tax implications for banks before moving into regulatory compliance considerations. Finally, ending our discussion with a few other CARES Act items to consider and additional resources we have available to you. First, we have Chad, who will start a discussion over lending programs. Chad?
Thank you, Theresa. Happy to be here today and discuss a couple of the lending programs available to banks and their borrowers. The first one that I'm going to cover, I think a lot of people will be familiar with. It's the Paycheck Protection program that came out of the CARES Act. As we kind of outlined here in our first bullet point, there have been 2 rounds of funding for this program thus far. The first one beginning on April 3rd and the $350 billion of availability under that was exhausted by April 16th, and the second round of funding began on April 27th, and somewhere in the neighborhood of about 10 days after that, the funding was gone for that. So currently there's no funding available under the program, but there's always the possibility that either additional funding or maybe some modifications to the program could be made in the future. So we'll kind of cover what the program is at a high level and then talk about some of the considerations. So, the background of the program is that it's available to small businesses in loan amounts up to $10 million, equal to 2.5 times the average monthly payroll cost of the borrowers. The loan, the first 6 months of payments are deferred. One item to note there is that existing 7A loans have a couple of automatic deferrals, either 6 months if they're retained or 90 days if the portion has been sold by the lender. And this deferral under this program is different than that other deferral program. So making sure that if you're thinking of the other program, it does have different treatments than the PPP deferral program. Other pieces of the loan, from the lender perspective, you get a fee ranging from 1% to 5%. It's 5% if it's under $350,000, 1% above $2 million, and 3% in between those amounts. The maximum loan size is $10 million with a contractual interest rate of 1% a year and a maximum maturity of 2 years. And the proceeds are to be used for payroll, interest on mortgages, rent, and utilities. And kind of the key point of the program and what lenders who've participated in it should be thinking about going forward is that there's forgiveness provision subject to qualifying expenses as noted above and certain restrictions on them. Just a quick note on who can lend under these. The easiest is a current 7A lender. Other institutions or companies are able to participate if your institution isn't a 7A lender. you do have advantages over other institutions to kind of become qualified for the program. But again, I think that's something that's probably occurred at this point, or if you're hoping for a third round of funding, could be an option there if you're not already approved. So at this point, again, most of the funds have been dispersed under the program. What are some considerations for lenders? So obviously, a big portion of this program is the forgiveness portion. It's kind of related to those payroll expenses and other expenses, and there's lots of questions currently as to what qualifies for certain types of expenses. Is it what's incurred, what's paid? Is it, benefits included in the different payroll costs? What if it's an employee over 100,000? How benefits associated with that work? There's lots of different questions that hopefully between now and when these loans are start to be forgiven, that'll be answered. But it's definitely a little bit of subjectivity out there. And additionally, it's been clarified that it's ultimately the borrower's responsibility to certify the accuracy of the information provided for forgiveness. But there is a requirement that the institution, provide some sort of good faith check or review of that information. And so lenders need to think about what kinds of processes they're going to have in place to support those decisions on the forgiveness. Kind of thinking about what happens if amounts aren't forgiven, or if a borrower enters bankruptcy at some point while this loan's outstanding. If different lenders make different decisions over the course of both funding and forgiveness, or if the same lender makes a different decision with different borrowers, how would that be viewed by the SBA? And a lot of the questions have been, as the compensation to the borrower, including the fee and rate, enough to justify this program? I think assuming that amounts are forgiven in a timely fashion, that the fees seem like they're sufficient for borrowers under the program. And then one additional thing to note for the program, if you're looking at liquidity sources for the loans funded under the program, the Treasury and Fed do have a lending facility, the Payroll Protection Program liquidity facility, that's available to borrowers, that is collateralized by the PPP loans, that matches the duration of the PPP loans and is at 35 basis points. So you do maintain a little bit of a spread between the rate of 100 basis points on the note and in that lending facility. And again, these loans are 0% risk weighted on your balance sheet. We've got a link here at the end to a couple other questions and considerations thinking about the PPP program. The next program that I want to talk about is the Main Street Lending Program. On April 3rd, the Fed and Treasury kind of announced a expanded scope and eligibility for the program. The program was meant to help reach out to some of the more medium-sized businesses and provide additional liquidity facilities to them, especially if they didn't qualify under the PPP program. One thing that's not explicitly stated here, but the biggest difference is this really is a funding source for companies. There's no forgiveness component. It's not intended to work the same way the PPP program did. It's just an additional avenue. There's 3 facilities offered under it, although there's kind of 2 main ones. It's either new loans, existing loans, and then under the new loans, there's a primary facility that kind of has different required contractual terms, and a different percentage of it would be purchased under the program, but it does relate to new funding for borrowers versus the existing loan program, which would be for existing borrowers. The loans are for businesses that employ up to 1,500 workers and have 2019 annual revenues of less than $5 billion. And the key is that, they were in good financial condition for the onset of the COVID-19 pandemic. You can use the program either to issue new loans if it's after April 24th, or you can expand existing loans under the program. And so the new loan allows for loans of $500,000 up to $25 million. There are other limitations there, of course. And then the existing loan program allows for increasing loans up to $10 million or a maximum of $200 million. The payments under each program will be deferred for the first year. Interest still accrues during that time, and it's capitalized into the loan at the end of the first year. There are different criteria that borrowers must meet to participate in the program. The fact sheets are available on the Federal Reserve website, so it does get specific, but generally it's not participating in some of the other programs and being a U.S.-based company. A couple of the key features for these lending programs from the lender side is that they have the ability to sell 85 to 95% of the loan. The new and existing loans can sell up to 95%, and then that primary facility can sell up to 85%. And the vehicle established by the Federal Reserve to purchase the loans will purchase up to $600 billion of loans through September 30, or if extended, or if the funds kind of are used before that date. Again, from the lender side, the fees related to the program, you get a fee paid to you from the borrower, origination fee from 75 to 100 basis points. You do pay a fee to the SVP when you sell the loan. However, you can pass that fee along to the borrower. And then additionally, the SPV will pay the lender 25 basis points to service the loan. So definitely a little bit more flexibility and an opportunity to provide funding for some of your medium-sized businesses that you serve. And with that, I'll pass it over to Gabe to cover some of the tax and accounting considerations for loan modifications.
Thank you, Chad. First off, it's important to note that the underlying accounting for modifications and troubled debt restructurings has not changed. And it's also important to note that as you make modifications for your customers, you should be thinking about the modification in terms of whether it falls within the parameters of the Interagency Guidance, and if not, then presumably it would be a CARES Act modification. Of course, there's always the potential that it falls under neither. So let's talk about modifications under the CARES Act first, which is obviously an unprecedented act by Congress that impacts accounting and financial reporting. The CARES Act provides you an option, and yes, it is an option, to suspend applying the requirements associated with TDR accounting, including reporting modifications as TDRs, and thus you don't have to report them as impaired, and also suspends the measurement of impairment. But to elect this option, the loan must be less than 30 days past due as of December 31st, 2019, and must be modified within the designated period as noted on the slide. We've listed typical modifications on this slide that are allowed under the CARES Act, with the most common being the deferral of interest and/or principal. Note a couple things. One, that there are no parameters on timing of modifications under the CARES Act, nor are there examples provided under the Act, and also that principal forgiveness is not allowed under the CARES Act, presumably because that measure would be considered more indicative of an actual TDR. Please note if you are providing a true payment holiday and not charging interest during the deferral period, there are income recognition consequences, with the most likely outcomes being to either recognize no interest income during that deferral period or to adjust the yield over the life of the loan, taking into consideration the revised cash flows. There's been a lot of confusion about the FASB guidance on interest income recognition, and we'd like to remind you that this was specific guidance to a zero interest rate period, or where it's a true payment holiday, where you're not charging interest at all, you're not recognizing any income. which in practice, we're seeing it does not seem to be a common concession actually being granted. Next, let's talk about the interagency guidance. The interagency guidance issued just prior to the CARES Act has since been updated, rendering the initial document issued by the regulators to an inactive status. There's also a Q&A issued by regulators that you will certainly find helpful. Again, it is important to note that the underlying modifications in TDR accounting has not been changed, and this guidance issued is, in our view, well within the construct of GAAP accounting and really a clarification of the application of GAAP. The interagency guidance provides specific examples as well as the regulatory expectations, such as not reporting loans with deferred payments as past due. Generally speaking, for short-term modifications for customers that are current at the time of modification and impacted by COVID, which short-term is being defined as a modification period for a period of 6 months or less, the institution is allowed to presume that the borrower is not experiencing financial distress, thereby eliminating half of the equation necessary to conclude a modification as a TDR, and thus taking the TDR discussion off the table. Of significance is that FASB also issued a statement agreeing with this interagency guidance in terms of how GAAP is applied to these short-term modifications. You can find more information on this and other COVID-related topics by following the link at the bottom of this slide. Next, I'd like to cover a list of the most common modification questions we are fielding currently. 1, should interest accruals continue? Well, as we've defined the short term of being 6 months or less, if your extension is 6 months or less, we believe, yes, you can recognize interest income. I think this gets complicated if you do 6 months and then you add a 3-month extension onto that. I do consider the 6 months a bright line test, and the discussions we've had with regulators and banks that have had discussions with regulators, 6 months is very much a bright line test. So if you go over that 6 months, for example, say, even if you give a 6-month extension and say the borrower misses that 7th payment, you strongly think you should be considering non-accrual status and potentially reversing interest income as well. Contractually, no, it's not past due. Agree with that statement, but the guidance is very clear. If you don't think if you can collect the principal and interest, you don't have to, and you shouldn't wait for a 90-day contractual time frame to hit to move it to non-accrual. So lots of discussion out there on that. I can't say there's lots of consensus on it, but that would be our view at this point. You have to disassociate the contractual past due status from the interest accrual. And then I think there is definitely a carve out in terms of SBA, like the SBA 7As and things like that, where there's government programs that they've issued guidance for all loans under that program. I think those you treat differently. I'm talking in terms of a commercial or consumer loan that isn't under a government guaranteed program or anything like that. You have to be really careful about interest accrual over 6 months. So definitely would encourage you where you can to collect interest payments to help support interest accrual as well. Number 2, how to account for the deferred payments after loan deferral period ends. Well, lots of different practices there. Balloon payment, probably most common. Seeing extension of terms, potentially a re-amortization, whether it's actually re-amortizing in the system. Here, a lot of people just talk about pushing the date out and then talking to their customers in terms of trying to get them to catch up to avoid a huge balloon at the end. Some of this really depends on system capabilities. So it's all over the board in terms of how people are dealing with these concessions for sure. Number 3, will regulators be critical if modifications are outside the 6-month deferral period as mentioned in interagency guidance? Well, I think they'll be critical of them if you're trying to recognize interest income and you're not collecting at least interest-only payments. So definitely be careful there. Under the CARES Act, you can do a 12-month deferral, and some of the government guaranteed programs support that. But anything over 6 months, I think you need to think twice about interest income recognition and rule of interest. Number 4, what documentation will be required to prove modifications are COVID-19 related? Well, I would say if you're having difficulty documenting that with all of the stay-home orders and things going on, probably isn't COVID related. I mean, even a business that's successful and is operating fully, I mean, they may have people sick and have operations impacted. So you should, if it's COVID related, you should be able to document that. Are there any regulatory compliance considerations to be aware of? I definitely think, credit reporting, you don't want to be reporting things past due that are not contractually past due, given you've pushed, payment dates out. And then again, on government guarantee type programs, there's different guidance on single family residence modifications, so be careful there. Number 6, how will this impact credit unions' liquidity given expected volume and duration of modifications? There's obviously facilities you can access, and I would point you also to the Q&A where it does discuss an option to sell held to maturity securities as well, so that might be something of interest to you as well. So I'll now turn it over to Kristine to cover the tax implications for loan modifications.
Great, thank you, Gabe. As a reminder, and before we move on from our discussion on loan modifications, we did want to refresh on tax considerations for loan modifications. As of note, if there are significant modifications, there could be tax consequences for the bank that would result in gain-loss income recognition or original issue discount income. As we're hearing with many of the institutions that we talk with, and as Gabe mentioned previously, a lot of the deferral periods are 6 months or less. There are safe harbors that do come into play when it relates to significant modifications. And some of those safe harbors, as they relate to change in timing of payments, include if payments are required to be paid within the lesser of 5 years or 1/2 of the original term of the instrument, then the loan modification rules for tax purposes are ones that generally the taxpayer can get out of. As a reminder, if debt is discharged, consider filing Form 1099-C to report the discharge of debt. And note that cancellation of debt may be taxable income to the borrower. However, there are several exceptions and exclusions that do apply. Moving on to the Family First Coronavirus Response Act. Of note, the Family First Coronavirus Response Act did expand the Family Medical Leave Act and paid sick leave requirements for companies with employees between 50 and 500. If your institution is one that saw this expansion, there are payroll tax credits to offset the cost of the impact to you as an employer. So be mindful if you are paying out additional amounts due to FMLA and sick leave under this new act, that there are credits that can be taken advantage of. Taking a look at the CARES Act tax implications, the first item to be mindful of, as many of you are well aware of at this point, are that there are deferred payments to July 15th. And those will include both income tax returns and estimated payments for first and second quarter. Those are for corporate and individuals, as well as a number of states that have automatically extended and deferred payments. Be mindful of keeping an eye out for state deferral periods, as they do not always conform to the federal deferral periods. Taking a look at the business provisions of the CARES Act, payroll taxes have been deferred. Banks can take advantage of this provision. The components that may be deferred are specifically the 6.2% component, and the deferral period is half of the amount will be payable by December 31st, 2021, and the remaining half will be paid by December 31st, 2022. As a reminder, this is going to apply to deferral period is through the end of 2020. Employee retention credits. We put the information in here on the employee retention credits simply because we've received a lot of questions from clients trying to understand whether they would be able to take advantage of these credits as banks are keeping their employees employed. The rules around the employee retention credit specify that it becomes available if there is a partial or full suspension of operations due to a governmental order. Alternatively, it comes into play if there's a significant decline in gross receipts in which there's gross receipts of less than 50% over the prior calendar year quarter end. When we look at these provisions and additionally the frequently asked questions that have come out by the IRS, it becomes rather clear that the government order provisions largely preclude banks from being able to take advantage of this retention credit. The classification as an essential business generally means that you're able to keep your doors open. And so being able to get beyond that to say that you would meet the first provision is certainly challenging. And then when we look at the second provision, thankfully, the industry is generally not in that boat. And so the banking industry is not largely able to claim the employee retention credits. Again, because of the number of questions that have come through, we have included information on it in the second slide here as well, but are not anticipating that under current circumstances, banks will be able to take advantage. Other provisions that have been a part of the CARES Act include net operating loss modifications for C corporations. Some of the provisions would allow NOLs to be carried back for up to 5 years, and these are NOLs generally arising in 2018 through 2020. The NOL 80% of inclusion limitation rule has also been deferred. And note that there are special rules for REITs. Similarly, on the flow-through side of the house, excess business loss rules under Section 461 have now been suspended for tax years 2018 through 2020. And this is provisions that otherwise would limit the amount of losses that can be claimed on a flow-through tax return. So what we see here from a planning standpoint is that the changes are generally allowed to provide companies with access to cash flow. Thankfully, we don't see as many financial institutions incurring losses at this point in time or large changes in their operating profits due to normal operations. However, we will keep our eyes on that within the industry. Where we have seen benefits come through, and keep your eyes on this, is for companies that have acquisitions, where there's acquisition costs in some of those open periods. We've seen across the nation that there have been a handful of institutions that have been able to take advantage of the net operating loss carrybacks from past acquisitions that have occurred, as well as keeping our eyes out as we go through the 2020 year as potential charge-offs may crop up. Another provision of the CARES Act that may come into play is the faster recovery of corporate AMT credit. Corporate AMT was repealed by the Tax Cuts and Jobs Act, with remaining credits recovered over 4 years. However, under the CARES Act, taxpayers are able to recover any remaining credit in the 2019 tax year. Alternatively, there is an election available to take a credit in 2018 and file for a tentative refund. One item to be mindful of is that there are still some Section 382 limitations that come into play as it relates to AMT credits. And so if you're an institution that has limitations on AMT that interplays with Section 382, there still are some quirky rules that taking a look at whether you can fully take advantage of these new provisions. With that, we'll turn things over to Noory.
Thank you, Kristine. Good afternoon. My name is Noory, and I wanted to discuss briefly some of the regulatory compliance reliefs that have been discussed and amended within the regulations due to COVID-19. So let's get started here. You know, the first item that we wanted to discuss was related to Regulation X, also described as the mortgage servicing rule. As of April 3rd this year, and until further notice, in evaluating compliance with Regulation X, if a mortgage servicer offers or provides a short-term option, including the CARES Act forbearance, the agencies do not intend to take supervisory enforcement action against servicers for the following. delays in sending the loss mitigation related notices, delays in establishing or making good faith efforts to establish live contact with delinquent borrowers, delays in sending the written early intervention notice to delinquent borrowers, and delays in sending the annual escrow statement. I think it should be noted that the agencies that were listed as a part of this joint release were the CFPB, FRB, FDIC, NCUA, and OCC. Some additional protections that were put into place by the CARES Act that I did want to mention were the foreclosure moratorium and then the forbearance program that we just discussed. We'll now move on to some of the changes that have occurred to the interagency appraisal guidelines. So this item, there were multiple items that were highlighted in the joint statement that was released by the OCC, FRB, FDIC, NCUA, and CFPB. But there are three items that I specifically wanted to highlight on today's call. The first item was related to the flexibility for physical property inspections. Although most of us are used to seeing appraisals include an exterior and interior inspection of the collateral. However, during the current emergency, it allows an appraiser to make extraordinary assumptions on the interior condition of the property, as long as the appraiser has a reasonable basis to do so. The second item is flexibility for appraisals of residential properties sold and underwritten to Fannie Mae and Freddie Mac standards. Currently, it does allow exterior only and desktop appraisals for certain loans that qualify. The last item is deferrals for completion of appraisals or evaluations. The completion of appraisals and evaluations required under the agency's appraisal regulations may be deferred by a regulated institution for up to 120 days from the date of closing. It should be definitely noted that this amended rule will sunset at the end of this year on December 31st. It should also be noted that the deferrals apply to both residential and commercial real estate related financial transactions, but exclude transactions for acquisition, development, and construction of real estate. Final item I wanted to discuss on today's call is related to the Community Reinvestment Act. It should be noted that this new development of the CRA was released as a joint statement by the FRB, FDIC, and OCC. It is only to be effective through the 6-month period after the national emergency declaration is lifted, unless extended by the agencies. And this is applicable to institutions below $1 billion in assets. What is highlighted is that agencies will now favorably consider certain retail banking services and retail lending activities in a financial institution's assessment areas that are responsive to the needs of low and moderate income individuals, small businesses, and small farms affected by COVID-19, and that are consistent with safe and sound banking practices. These activities may include, but are not limited to, waiving certain fees, such as ATM fees, overdraft fees, late payment fees on credit cards and other loans, early withdrawal penalties on time deposits. Additionally, easing restrictions on cashing out-of-state and non-customer checks, expanding the availability of other short-term unsecured credit products for credit-worthy borrowers, increasing credit card limits for credit-worthy borrowers, and offering payment accommodations, such as allowing borrowers to defer or skip payments or extending the payment due date, which in turn would avoid delinquencies and negative credit bureau reporting caused by COVID-19 related issues. The other area that was highlighted as a part of the CRA adjustment or amendment was community development activities. Qualifying activities include those that help to revitalize or stabilize lower moderate income geographies as well as distressed or underserved non-metropolitan middle income geographies. and that support community services targeted to low or moderate income individuals. Such activities may include, but are not limited to, loans, investments, or services that support digital access for low and moderate income individuals or communities, loans, investments, or services that support access to health care, particularly for low and moderate income individuals or communities, economic development activities that sustain small business operations, particularly in low and moderate income communities, and finally, investment or service activities that support provision of food supplies and services for LMI individuals or communities. Thank you, and I will pass it off now to Theresa.
Thanks, Noory. To wrap up our discussion today, we'll highlight a few other items of significance from the CARES Act. The first one's related to temporary relief from CECL. Large publicly traded banks were required to adopt Accounting Standards Update 2016-13, Measurement of Credit Losses on Financial Instruments, which is effective as of January 1st, 2020, and would have been required those banks to apply CECL during the first quarter of this year and included its impact in their first quarterly earnings. The CARES Act delays CECL implementation for these banks if they so choose. In addition, on March 27th, the Federal Reserve, FDIC, and OCC issued an interim final rule that allows banking organizations that are required to adopt CECL this year to mitigate the estimated cumulative regulatory capital effects for up to 2 years. The relief offered by the CARES Act and interim final rule are in addition to the 3-year transition period already in place. The second item in the community bank leverage ratio, which is in the final rule, was to be effective on January 1st, 2020 for community banks who elected to utilize the simplified measure of capital adequacy, which required a leverage ratio at or above 9% to be maintained. The CARES Act has now reduced that leverage ratio to 8%. A joint press release issued by the Board of Federal Reserve, FDIC, and OCC on April 6th outlined 2 interim final rules to provide the temporary relief outlined in the CARES Act, which began in the second quarter of 2020 and will be in effect for the remainder of the calendar year. Then it will increase the required ratio to 8.5% for 2021 and back to 9% thereafter. There's also a 2-quarter grace period for community banks whose leverage ratios fall no more than 1% below the requirement. The next item we want to discuss in this CARES Act relates to providers of information to credit reporting agencies, like banks who agree to an accommodation on an account of a consumer impacted by COVID-19, which these providers of information will continue to report the account as current or as the same status as before the accommodation. Such credit protection started January 31st and ends at the later of 120 days after enactment or 120 days after the national emergency is terminated. The final item, as it relates specifically to the CARES Act, we'll address is the pause of foreclosure and federally backed mortgage loans for not less than 60 days beginning March 18th and temporary forbearance for federally backed 1 to 4 mortgage loans experiencing financial hardship due directly or indirectly to COVID-19. Borrowers may request up to 180 days, as well as an extension of a second 180 days. The temporary forbearance for up to 90 days is also available for federally backed multifamily mortgage loans, subject to rental protections during the forbearance period, including no rent, no tenant evictions, or late charges. We've covered a tremendous amount of information today, but there are a few other items we wanted to address that are worthy of noting. The FASB proposed delaying the effective dates of its standards on revenue recognition and lease accounting for certain entities because of challenges related to the coronavirus pandemic. The lease accounting standard is scheduled to take effect for private companies and private not-for-profits for fiscal years beginning after December 15, 2020. The proposal will defer the effective date for these entities to fiscal years beginning after December 15, 2021. Another aspect to consider is if goodwill is recorded on the books and if the current economic environment has caused triggering events, which would require an evaluation of goodwill for potential impairment. No one could have predicted that a global pandemic would lead to this extraordinary disruption and dislocation in the capital markets and the quickest end to a bull market in history. Markets have recovered some, but banks will need to consider whether an immediate triggering event has occurred and continue to monitor the need to reevaluate. The final item we'll leave you with today to consider before moving on to some of the additional resources we have available to you is going concern. Companies will need to take into consideration their specific circumstances and whether they have the ability to continue the going concern within 1 year after the date in which the financial statements are issued or available to be issued. To end with some final thoughts, as we're all navigating through these challenging times together, we maintain an active, dedicated website to COVID-19, and you can find the link on the slide. We also encourage you, if you're not already subscribed, to receive our insights and alerts that you do so, and the link is on the slide as well. This allows you to stay on top of current accounting, tax, regulatory items that are published, and any additional information that we put out. Again, I want to thank all of our presenters. As I had previously mentioned, our contact information is within the slides.